Let's get in now to the defensive sell signals. Sometimes you are not going to get the offensive sell signals, and you won't know that it's time to exit a stock until it begins to break down. Now, before we go into each of these defensive sell signals of selling into weakness, there are a number of drawbacks to selling into weakness. The main one is that if you're selling on the way down, you're giving back some of your hard-earned profits. And that is not easy for a lot of people to do. How many people here find it easier to sell into strength as opposed to selling into weakness? And how many people find it easier to sell on weakness? More? Okay. I am one of those people that find it much more difficult to sell on weakness. I like to sell and take profits along the way. So again, one of the major drawbacks is you're going to give back a lot of your gains. And I find a lot of people have trouble selling when their stock moves down because rather than sell when it moves down, they want it to bounce back up to where it was before they begin selling. That's really normal human nature. Deep down, we all want to sell right at the peak. And when we miss our opportunity, we'd rather wait for a bounce than sell when we're down 10 or 15%. Trust me, you can lose a lot of money waiting for that bounce. Some people will hesitate and lock up when their stock moves down very quickly or sharply, and they're not prepared for it. And by the time they finally come to their senses, the stock is down so much, they feel they have no choice but to hold on to it and dig in their heels and wait for their bounce, or they go into a state of denial. They become that proverbial long-term investor. They didn't start out like that, but now that their stock is down 20, 25%, they're a long-term investor. Let me tell you what's going to happen, and I know this from painful experience. You're going to hold that stock, and it's going to go lower and lower, and at some point, you're going to say, I can't take it anymore. How did I make this mistake? Get me out of the stock, and you're going to sell it right at the bottom. And when you're selling it, you know in the back of your mind, you're at the bottom. You're capitulating, but you do it anyway because you can't take the pain. This has happened to me many times in the past. We all made a lot of mistakes at the firm learning how to trade, and this is one of those mistakes I've made more than once. The only way I know of not capitulating at the bottom is to never put yourself in that situation to begin with. Okay? Just know ahead of time you're not going to be able to handle it. The last drawback is if you're in a stock that's not liquid and you have a lot of shares, your own selling is going to push down the stock even further. You may not be able to get out of the stock. So really it's important to kind of know what you're trading and know that you can get out of the stock if you have to. Whenever I have taken on an enormous position in something that's not very liquid, I almost always have paid a price for it. For some reason, I still continue to do it sometimes, but usually they don't end up well. By and large, I trade much more kind of bigger institutional stocks that I know if I have to sell 100 or 200 or 300,000 shares, there's someone there to buy it. Okay, so let's go through each of these defensive sell signals. The first one on page 413 is a weekly close below the major uptrend line. Now, conceptually, this is similar to the break above the upper channel line, but whereas the break above the upper channel line indicates that your stock has gotten ahead of itself, that it's extended above its normal rate of growth, a break below the uptrend line suggests that the trend has changed. You've broken down below a very important level of support. The same rules apply to drawing the uptrend line as the channel line, except this time you're drawing it along the bottom of the price bars. And again, you want to stick with a weekly chart, a log chart, and you want to connect at least 3 points over a period of at least 18 weeks. The more points you connect and the longer the line and the longer the period of time, the more support that line is going to give you. So if you continually get support there again and again, and finally you break below it, your trend has changed. Now, this is typically not going to be one of your early sell indicators. Usually, it's going to actually be one of your later sell indicators. You will typically get a number of other sell indicators before there, but this is kind of one of those last resort indicators typically. And oftentimes, you'll notice that it breaks an uptrend line at the same time it breaks a 50-day moving average. Let's go over an example. Here it is on a line chart. 5 points were connected along the lows of this weekly chart, and when you finally break below it, that's your indication to exit the stock. So on the next page, 414, we have Alcon. Alcon broke out of a double bottom base with a handle, and then went into a flat base. And then it went on this run over here, and we were able to connect 1, 2, 3 or so. Is there a point over here? About 4 points along the lows. And then once you break down below that point, the trend has changed and the stock moved down very badly from that point. Notice how you broke the trend line at the same time you broke your 10-week moving average. So you had kind of double evidence there. You had a lot of evidence that the stock was getting into trouble. Here it is on a daily chart. You get your support at your 50-day moving average on 3 occasions up here. And then you finally break down. And just as you're breaking down, you're also breaking your trend line. Now, you also had an opportunity to get out on strength. Offensively, you had new highs on low volume over here. So you may have just sold a little bit up here before the stock really got into trouble. Oftentimes, you won't be able to draw a channel line on a chart. They won't connect properly. First of all, you can't always draw a channel line or a trend line, an uptrend line. It's not a bad idea to draw both lines if you can on a chart. A lot of times if you can get parallel lines going on your chart, you'll see the stock trade within that range along the way up, and you can trade off of that. It's not a bad idea at all. If you can draw your channel line and your trend lines, you should. It's always a good idea. The next one on page 418, GGB. Now this stock broke out of a cup with handle, and then went on a nice steady advance, and we connect 1, 2, 3, 4, 5 or so points along the lows, and again you finally break down below that line, and it's all over from there. You also got some stalling action at the top. We're going to talk about stalling in a few minutes. Here it is on a daily chart, and again support at your 50-day along the way up, and you finally break down below that line, and that's going to coincide with your trend line. I didn't draw the trend lines on the daily chart because you want to typically draw them on a log chart, on your weekly chart. Okay, let's move on to the break below the 50-day moving average line on page 425. Of all of the sell indicators we're going to talk about today, this is my favorite, because based on our model book studies, we've seen that this line will sometimes contain an entire advance from the initial breakout all the way to the top. So if all you have in your arsenal of tools is this one sell indicator, and you've got tremendous discipline and patience, you can participate in an enormous run. There's even that Qualcomm that I showed you earlier, 2,500% without breaking the 50-day moving average. So you can make some tremendous moves with just this one indicator. When a stock is in an uptrend, you're going to see it pull back and typically get support around your 50-day moving average. And the reason is because institutions like to add to their positions around that range. Remember, institutions are big. They've got a lot of money. It takes them a lot of time to build positions. And they don't want to continually buy when the stock is going up every day. They don't want to drive their average cost up too high. So you'll normally see institutions come in and buy the dips. And it just so happens that around the 50-day is generally where you see that kind of action. Sometimes a stock will break below the 50-day very temporarily. It might be intraday. It might be just for 1 or 2 days, but it'll stay close to that line. That's what we call a shakeout. Because if your stock is breaking below the 50-day, it's going to look horrible, and it's going to scare out all the weak holders. Now, I got a question during the break on should you wait until the end of the day, or should you just sell when you're off 8%, or when do you sell based on this line? I almost always wait till the end of the day to make my decisions, because I don't want to be one of those guys that's shaken out early in the day. So if a stock breaks down below that line early in the day, but I see it gets support early in the morning and continually begin to move back up, then I'm typically okay, and I'm going to stick with that stock. I might even add to it. It's not wrong necessarily to sell it early. Sometimes you'll find a stock break below it, and it doesn't get support. It just gets weaker and weaker and weaker throughout the day, and you miss out on a good opportunity to sell it at better prices. But that is the risk you take. And I would say it's kind of 50-50, and it's really going to depend, I think, on your personality. For me, I'm typically patient enough to wait. Mike usually will react a little quicker, and if it gets support, he might have to just buy it back. So this is different ways of doing things. There's no one right way to do it. So the question was, do I use a simple or exponential moving average? I use simple moving averages. Mike uses an exponential, like an exponential 21-day, I think he'll use. I just use the normal, simple 50-day moving average, and I think that's what is on our charts already. If your stock breaks the 50-day decisively, so it doesn't get back close to that line, if it's decisive, and it's the first time on that chart after you successfully tested that area before, that's a really bad sign, particularly if it occurs on heavy volume. Most often, a bad break below the 50-day is going to lead to further weakness. So if your stock's had a good move and you break that 50-day for the first time, it looks bad, it's time to sell it, typically, and at least wait till the stock, builds a base. So let's go over some examples. This is a new chart that we're going to cover. This is page 430, and this is Employee Solutions. And this stock had a tremendous move. It broke out of a cup with handle down here. It had is that a 2-for-1 split? It broke out down here and moved up 8 or 9-fold from this point without really testing the 50-day or 10-week line, except for this one occasion in here, basically. Pretty much that line kept you in the stock the whole way up. If you had gotten shaken out over here, you'd have to buy it back. But that one sell rule would have kept you in a tremendous run. Let's look at it on the daily. I would not consider that a climax. It doesn't really follow the typical signs we covered. But you can see your 50-day moving average here is the red line, and the stock got support again and again and again at that area before finally decisively breaking it. Now, what other rule can you see would have gotten you out of the stock before a break below the 50-day? Low volume? So we have low volume, new highs. Very good. That's not on your chart, right? If you look over here, you got this 2 weeks down, 1 week up to new highs. After successfully testing the 50-day on one or more occasions, you get this very severe price action. It's different than this. This looks different than that. Here you've got your largest one-day drop, then another gap down. This price action is much more severe than that price action. I'm not saying that's easy, but it's not as bad as this. And you go right back up. You could be selling offensively into here. You could be selling offensively on this light new highs on light volume. And finally, you'd have to be selling down here too. So again, the point of our rules are to get you out somewhere near a peak so that your average cost on getting out of the stock is, maybe within 10 or so % of the peak. And if you're doing that consistently, you're going to be way, way ahead of the game. On page 442, we have Pulte Homes. And this goes back to the early 80s. And this broke out of a cup with handle and kind of just doodled around, didn't do much until it really got going over here. And it went on a tremendous spurt, going up about 10-fold in a short period of time. And look at the 10-week moving average line. It contained the entire advance along the way. Now, I know me, the way I trade, I never would have made that kind of money in the stock. I would have been out way early. I don't have the guts to just watch all my profits keep building and building and building without realizing any of them. So the question was, would I sell partial positions along the way? What I would probably try to do, and I'm going to get into a lot of detail in this after lunch, is trade around a core position. So I would keep part of my position that I would not sell until I see the sell signals that we've been talking about all morning. But part of me would, when I feel it's too far extended, sell some and try to get back at a lower entry point. Chances are on a stock that's this powerful, I would have messed it up. It didn't give you a lot of opportunities to get in. It just kind of went up. And that's the risk of having an active trading style like I have. And we'll get into that in some detail. Notice at the peak, you've got 2 weeks down, 1 week up to new highs. And this is what it'll look like on the daily. So you've got your support at your 50-day moving average the whole way up. And then right before you roll over, you get that bad breakdown for 2 weeks. You shoot right up into new high ground, and then you roll over. And decisively, you're breaking your 50-day here for the first time. And if you didn't get out on this offensively up here, you'd be selling down here, and you still did really, really well. Okay, the next one is when a stock has its largest daily point loss since the beginning of the move. And this is on page 447. If a stock has a really bad day, a really big point loss, the biggest it's had for the entire run, and if it occurs particularly on heavy volume, then that is your indication that there is probably some institutional selling. And so you might want to sell some shares. Now, I'm not suggesting that one bad day in your stock means it's all over. Stocks will have bad days from time to time. But sometimes that very first day is just the beginning of a much larger decline, so you want to take notice of it. So again, if it's just your first sell signal, maybe you just sell a little bit and see what happens. If nothing else, it should put you on guard that your stock might be getting into trouble. So on page 451, we have Intercontinental Exchange. Now this is that stock I was telling you about that I was actually in. I traded this stock. I had made a tremendous amount of money in this stock on the way up, and I had an enormous position in it. It had its first one-day point drop here, and I didn't do a thing. Now, part of my thinking was this stock really hasn't come down to the 50-day moving average yet. Remember I said usually at 50-day moving average, I'm going to give a stock that opportunity to get down there and move up from there. And this is one of those kind of rare instances where a stock just didn't get support. It just came back down to that line and was up for one day, and boom, you broke it. So again, you can't always rely on your lines. Sometimes they're not going to cooperate the way you'd want. By the way, that 50-day moving average, as great as an indicator as it is, if your market begins to roll over, if you're no longer in a general market uptrend and you're starting to roll over and the general market's getting into trouble, the 50-day will not work. That's actually really important to maybe write down and keep on top of your mind, that you cannot buy off the 50-day in a bad market. They're all going to fail there. A small correction is going to be fine, because that's probably when the stocks are moving down to the 50-day. A 3, 4, 5, 6% correction, those are normal, and that's when your stocks will be coming to the 50-day. But if you find your general market getting into trouble, and I mean breaking down below important levels of support, breaking down below the 50-day moving average, for instance, no longer logging higher highs and higher lows, that kind of action, then your market might be getting into trouble, and the 50-day, your stocks will not get support there. So here's an example of just your first bad day leading to just much lower prices, and I was in a little bit of denial. That's what happens when you've got a big position and you've made a lot of money on. It's really hard to part with. I finally got out around here. On 455, we have San Filippo. And the stock breaks out of a double bottom base and has a nice run up. And right after you hit a peak, you've got your largest one-day point loss of the entire move. You get support at your 50-day moving average, and you bounce up, and you get a little weak rebound rally here. And you break again, and you get another weak rebound rally. So you get two opportunities to get out on these little bounces here, and then you really fall apart. So again, you're going to see more than one sign, and your job is to react to each of them little by little, okay? The last set of tops we're going to cover are called distribution tops, and distribution tops fall somewhere in between offensive and defensive. And this is on page 462. And there are a number of different forms of distribution. We've got churning and stalling action, downside reversals, railroad tracks, and island tops. So let's begin with the churning action. Churning or stalling is defined as heavy volume without further upside price progress. Okay, and you normally, if a stock has this kind of action, it's typically going to be after it's had a significant move and it's near new highs. And what you'll see is that volume will remain heavy, but the stock won't be moving anywhere. It will be going sideways. Generally, you will see the price action, the daily price action, be such that you'll see either downside reversals each time it tries to get to a new high. You'll see the stock close in the lower part of the range. You'll see weakness on a daily basis over this period of time. The churning could last 5, 6, 7, 8 days, up to maybe 3 weeks, typically, before the stock will really roll over. What churning indicates is that the smart money has already played the stock, and at these levels, there's more than enough sellers around to soak up demand from new buyers, so the stock can't get anywhere. So let's go over an example. This is on 472. Did anyone trade dry ships back? Yeah? You make money in it? Yeah? All right, well, guess where I bought dry ships? I didn't buy it here, breaking out. I didn't buy it coming out of this consolidation or even over here. I bought it right there. So I make mistakes too. Okay, I'm not alone. Good. My analysis at the time was it was a high-tight flag. Now, if you go back in your workbooks and look at your high-tight flag examples that Mike went over, what you will find is that that does not look like a high-tight flag. When you look at your high-tight flags, you'll see that the weekly volume during that flag portion, during the consolidation, you get typically a dry up in volume. Here you get your 2 largest down weeks of the entire move up. That is distribution. And they're downside reversal weeks too. They're in new high ground, but they close at the low. So this is a tremendous amount of distribution right at the peak. Also, the flag isn't long enough. It really needed at least another week to really be maybe considered a high-tight flag. But it was just wrong. I was looking for an excuse to buy the stock. I missed it the entire way up. It had that amazing story, and I was one of those guys where the smart money was selling to me. And here it was on a daily chart. So, we all make mistakes. Again, this whole area here, your volume is increasing. It's holding near the highs, which is impressive, but this is really the smart money getting out of the stock. And right on that day, I bought it right as it was breaking out. Now, the only good thing about it is if I was paying attention, you know exactly where you're wrong. If you buy it on that top day and you break down below the previous day or two, then it's wrong. You broke down over this little ledge, this little area of support. Now, unfortunately, it moved down so quickly, you never would have been able to sell it there. But this is what I talk about, low-risk entry points. You know when you're wrong. All right, the next sign of distribution are downside reversals. Typically, you'll see them on the daily chart, but you can also see downside reversal weeks. A downside reversal day occurs when your stock goes into new high ground, but by the end of the day, it comes all the way back down, closing at the low part of the range and down for the day, and often on a pickup in volume. Now, you're going to see this kind of action occur all the time. It's normal for stocks to have downside reversals. And it doesn't necessarily mean your stock has hit an ultimate peak. But what it does mean is that in the short term, the stock is probably going to come down for at least a few days. Okay, and that's very important for you to realize, because having an expectation of what is normal with your stocks is going to keep you from panicking at a low. So if you're in a stock and you have no idea where it's going, you just know it's going up and you feel good about it and you've got a cushion, and next thing you know, the stock's down 20% in 5 days, you might panic. You might sell it. But if you see a downside reversal and you say to yourself, the stock's probably going to come down for another 4 or 5 days, it might come off 15 or 20%, you make a decision. Do you want to sit through it or not? So you can make a decision and decide how you want to play it. And if you want to stomach it and sit through it, at least you know what you're in for. So let's go over another example. This is GGB, and we looked at this stock earlier in a different part of the move. This is on page 476. And this is classic distribution or churning action. And we talked about the churning and stalling on that dry ships. This is even more classic of what you'd see. You get about 5 weeks here where the stock is trading at new highs. It's on heavy volume, but it just can't seem to go any further. And here it is on the daily. Now look at it. Each time it goes into new high ground, it reverses. That's a downside reversal right there. New high ground, close at the lows and down for the day. You bounce back up, another downside reversal. Again, you're in new high ground, another downside reversal. So that is that weak daily price action I was talking about that you're going to see during this churning phase, where the stock gets selling pressure every time it flirts with new highs. And you can see each time you get that day, you get further days of selling. And finally, you break below this range here, and then it's all over from there.
Do you use buy stops or sell stop orders, or just use mental stops?
So the question was, I use buy or sell stops. I use mental stops. I hardly ever put in a hard limit, either below or above. Sometimes I'll use buy limit orders on the downside. If I'm trying to buy something on a little weakness, I'll put it down at a certain area of support, and say if it hits there, I want to buy it, I'll just put it in. But typically, I'm not putting in those kinds of orders. Okay, here's another example. This is Netflix, and this is back in 2004. And this is on page 482. And again, the stock is at new highs, and it's just basically consolidating here, holding its ground, but you've got 2 downside reversal weeks in here, and you've got stalling action. Well, that first week was just kind of stalling. It wasn't so much of a downside reversal. The second one was a downside reversal. But it's basically stalling action. The stock isn't moving up any further, and you still have heavy volume. Here it is on the daily chart. On the daily chart, you do get your downside reversal right at new highs, and then you, again, flirt with new highs, and you get another downside reversal. This kind of action typically means at least temporary weakness is coming around the corner. Okay, railroad tracks. You don't see them too often in the charts. They're typically associated with climax tops when you do see them. And railroad tracks are going to resemble 2 parallel lines on the weekly chart, where the first line represents a wide weekly spread at new highs, and then the next following week retraces the high and low of the previous week. And it's going to occur on heavy volume. So again, it's heavy volume without further price progress up. You're just retracing the previous week's action. The way we've organized the book on the distribution is we've just put all the different forms of distribution in. The charts are all alphabetical, but they're all marked clearly on each chart. So in that section, you're going to see downside reversals, churning action, railroad tracks, island tops. You're going to see them all in there. So here it is. Over here, you're at new highs. You have this wide weekly price spread, and then the very next week, you go all the way back down and close slightly up on heavy volume. And again, heavy volume without further price progress. And it wasn't the exact top, but it was close to the top. You get some downside reversal weeks in there as well. So in 488, here's a new chart in your workbook. Did anyone trade STEC this year? Okay, STEC was a pretty tough stock to get out of. It didn't give you a ton of signs, but upon analyzing it, in hindsight, it did give you a couple of clues that it may have been peaking. Right on this week here, you get a wide weekly price bar, and then the very next week you retrace that entire distance. So those are your railroad tracks. Heavy volume without further price progress, then you go up a little bit the next week before falling. So it's this action in here. It's hard to see the railroad tracks on the daily charts. We only look at them on a weekly. But it was this churning action in here. If you look on there, you got your railroad tracks. Clearly, if you didn't get out some with the railroad tracks and your largest one-day point drop here on this reversal, so here's another downside reversal, and your largest daily point drop of the entire move. So you've got kind of two clues there. You've got your railroad tracks, so that's your three clues. You've got a little bit of stalling at new highs. That's a little clue there, 4. And so you'd be out of some of it at least. And then if you got caught in this gap down below your 50, you're done. Schnitzer steel on page 490. Here are your railroad tracks right here on the weekly chart, wide weekly price bar. The very next week you retrace that entire distance. It manages to make a little more progress, but again, we're trying to get out somewhere near the peak. It could be a red week. Usually it's going to close right around the same price, but it could be red. These two examples I showed close slightly below, but retrace the entire distance. You have your downside reversal right on the peak week on this one. Here it is on the daily chart. Now, if you were still in the stock even after the railroad tracks, you had new highs on low volume right in here. That may have been a little bit helpful. And then you get this decisive, huge one-day point drop on a gap down, so you'd be selling there as well. And lastly, we have island tops. And again, island tops are going to typically be associated with climax tops. And an island top, you're going to see it on a weekly chart, and it occurs when you see a stock gap up to new high ground from the previous weekly range, and then the very next week it moves right back down to where it was before. So that island week, that top week, is standing all alone. There are no price bars next to it, which is why we call it an island top. Usually on that week, the stock is going to close somewhere kind of in the mid to lower part of the range, showing you that there's been distribution at those high levels. It's never as clear as that. In fact, I was looking over the examples last night that I'm going to cover, and they're not as easy on the weekly chart. This is kind of what it looks like. This is a pretty good example. On page 464, you gap up into new high ground, you're closing mid-range, and the very next week you come right back down to the previous area. But you can see there's some overlap, so it's not picture perfect. Nothing in reality in the market is usually picture perfect. On page 494, we have SunPower, which had a climax top. And this is kind of a little more typical. You have this classic climax top. And on this week here, you go way into new high ground. And the very next week, go right back down. You notice how you close right at the low part of the range on that top week. That's typically what you're going to see. On the daily chart, you can kind of see the gap up. You can see how it gaps up from that range. That's your exhaustion gap. And it comes right back down. So your island week is these days right in here. A lot of times you'll see during a move, a stock will come down and test the gap and partially fill the gap, which is normal and fairly constructive. But if you actually close below that gap, that's usually a more ominous sign and more negative. So that's an example of that. And you would have gotten out because that's your climax top as well. Titanium metals on page 496. Another climax top example with an island top right at the peak. New high ground, and the very next week you come right down to the previous range. This is really where I would normally start the climax. Even though it's only several days, it's off a short consolidation, and that's where you would normally start it. This is one of those examples that went longer than the 3 typical weeks. Normally, I'd say 8 days is what you'd find. If you had to do like the median of all climax tops, 8 days would be your peak day.